Economic indicators are often presented as dashboards, numbers flashing across screens, charts rising and falling, headlines declaring strength or weakness with confident urgency. To most investors, these indicators feel either intimidating or irrelevant, too technical to trust, too abstract to act on. But financial celebrities who navigated decades of cycles learned something different. Economic indicators are not signals to obey. They are context to interpret. The danger of economic data is not that it is misleading, it is that it is partial. GDP, CPI, unemployment, PMI, yields each measures something real, but none measures the whole. Investors who treat any single indicator as truth tend to overreact. Those who learn to read indicators as fragments of a larger story develop patience instead of panic. Gross domestic product, for example, is often treated as the scoreboard of an economy. Growth is good, contraction is bad. But financial celebrities learned early that GDP is a rearview mirror. It tells you where the economy has been, not where it is going. By the time GDP confirms a recession, markets have usually moved. By the time GDP celebrates recovery, opportunity is often already priced in. More importantly, GDP measures activity, not quality. It counts spending regardless of whether that spending builds durable value or temporary relief. Reconstruction after disasters boosts GDP. Debt-fueled consumption boosts GDP. Financial celebrities learn to ask a deeper question. What kind of growth is this? Productive investment growth behaves very differently from consumption pulled forward by credit. The number is the same, the implication is not. Inflation indicators, particularly CPI, present a different challenge. CPI feels immediate because it touches daily life, food, rent, energy. But CPI is not inflation itself, it is a proxy, a constructed basket, a compromise between accuracy and practicality. Financial celebrities learn that CPI often lags reality and smooths extremes. It underweights certain pressures and overweights others. Treating it as precise truth leads to misjudgment. More subtly, CPI affects psychology before it affects policy. When people believe prices will rise, behavior changes, spending accelerates. Wage demands increase. Savings behavior shifts. Financial celebrities paid close attention to this expectation loop. Inflation is as much about belief as it is about measurement. CPI reflects the past, expectations shape the future. Employment data tells another partial story. Low unemployment is celebrated as economic strength. High unemployment signals distress. But financial celebrities learn that labor markets lag cycles significantly. Companies hire late and fire late. Unemployment often looks strongest just before conditions deteriorate. Interpreting labor data without this lag creates false comfort. Interest rate sensitive indicators, bond yields, yield curves, credit spreads offered financial celebrities a different lens. These indicators reflect capital's expectations. When long-term yields fall while short-term rates rise, something is being priced beneath the surface. Yield curve inversions are not magic signals. They are expressions of uncertainty about future growth. Financial celebrities did not treat them as timers, but as warnings that the economic narrative might be unstable. Purchasing managers' indexes and business sentiment surveys added texture rather than answers. These indicators captured mood, confidence, hesitation. Financial celebrities valued them not for precision, but for direction. When sentiment detached sharply from hard data, something usually adjusted later, either expectations or reality. Another critical lesson was understanding who the indicators serve. Government data aims for consistency and comparability, not trading accuracy. Markets move on marginal changes and surprises. Financial celebrities focus less on the absolute number and more on the deviation from expectation. Data that meets forecasts often moves nothing. Data that disappoints consensus moves everything. Economic indicators also interact with each other in ways beginners often miss. Strong GDP alongside rising inflation invites tightening. Weak GDP with falling inflation invites stimulus. But mixed signals create policy paralysis. Financial celebrities learn to think in regimes rather than points. Indicators rarely agree cleanly. Interpreting the direction of conflict mattered more than finding clarity. Another trap is data revision. Many indicators are revised months later, sometimes materially. Financial celebrities treated early releases as estimates, not facts. Overconfidence in preliminary data produced whiplash decisions. Patience outperformed urgency. Importantly, economic indicators are national averages. Markets are not. Entire industries can boom while GDP slows. Entire sectors can collapse while CPI moderates. Financial celebrities learn to separate macro context from micro opportunity. Indicators set the weather. They did not dictate individual outcomes. Another subtle insight is that indicators change behavior simply by being observed. Policymakers react to them. Businesses plan around them. Investors position ahead of reactions. This reflexivity means indicators are part of the system they measure. Financial celebrities understood that once everyone watches the same data, its signaling power changes. As experience accumulated, the most seasoned investors stopped asking what indicators say and started asking what they miss. What is not measured? Informal labor, asset inflation, leverage in private markets. Structural fragility. Financial celebrities paid attention to these blind spots, knowing that crises often emerge from what statistics cannot see. Over time, economic indicators became less intimidating and more humbling. They were no longer instructions, but reminders of uncertainty. They disciplined expectations. They framed probabilities. They prevented overconfidence during good times and despair during bad ones. And this is where the story begins to narrow. Because once economic indicators are understood not as commands but as clues, each incomplete, each delayed, each biased by construction, the investor's relationship with data matures. The question stops being, what does this number mean, and becomes, how does this change the balance of risks? It is at this point, where indicators inform judgment without dominating it, that macro understanding becomes an asset rather than a distraction, shaping patience, positioning, and perspective across cycles, unfolding not through precise calls, but through a calmer awareness of where the economy has been, where it might be heading, and how little certainty any single number can ever provide, like learning to read a map without confusing it for the territory itself. And this is where understanding economic indicators reaches its most practical and disciplined form, not as a way to predict markets, but as a way to avoid being misled by them. In the second half of this lesson, financial celebrities stop reacting to indicators and start triangulating them. No single number is trusted in isolation. GDP without inflation context is noise. CPI without wage dynamics is incomplete. Employment without productivity is misleading. The goal is not certainty, it is balance. Indicators are weighed against each other to reveal tensions, not answers. One of the most important habits seasoned investors develop is separating signal from policy response. Markets rarely move because GDP grew or CPI cooled. They move because investors anticipate how policymakers will react to those numbers. Financial celebrities learn to think one step ahead, not guessing outcomes, but mapping incentives. When inflation rises, what must central banks do to maintain credibility? When growth slows, how much pain is politically tolerable? Understanding this reflex loop mattered more than memorizing the data itself. Another crucial refinement is time frame alignment. Economic indicators operate on macro time. Investments operate on portfolio time. Financial celebrities match the two deliberately. They did not overhaul portfolios based on monthly prints. They adjusted exposure when clusters of indicators suggested a regime shift, tightening to easing, expansion to contraction, stability to fragility. Patience here was a competitive advantage. They also learned to read rate of change, not just level. A high CPI falling rapidly can be more bullish than a low CPI rising quietly. A weak GDP improving can matter more than strong GDP decelerating. Financial celebrities focused on acceleration and deceleration, the direction of pressure because markets price change faster than they price states. Another subtle but powerful discipline involved humility about data quality. Financial celebrities assumed error. They expected revisions. They distrusted precision. This skepticism reduced whiplash. Decisions were sized conservatively, staged over time, and reversible where possible. Economic indicators informed posture, not bets. Crucially, the best investors never allowed macro data to override micro reality. A great business did not become bad because GDP dipped. A fragile balance sheet did not become safe because CPI softened. Economic indicators set the environment. Fundamentals determined survival. Financial celebrities used macro to modulate risk, not to replace analysis. Over time, indicators also became tools for expectation management. When optimism was universal and data pristine, risk was elevated. When pessimism was extreme and data dire, opportunity often formed. Financial celebrities watched how markets felt about indicators, not just what indicators said. Sentiment, when detached from reality, corrected violently. Eventually, economic data became calming rather than stressful. It framed uncertainty instead of amplifying it. Investors stopped asking for certainty and started asking better questions. What would need to change for this trend to reverse? What assumptions are embedded in prices? What risks are being ignored because numbers look reassuring? And so the lesson resolves into a disciplined posture. Economic indicators are not steering wheels. They are instruments. They tell you altitude, speed, pressure, but they do not tell you where to go. Investors who survive cycles use them to avoid stalls and crashes, not to chase turbulence. If this reflection resonated with you, pause and ask yourself one question. When the next data release surprises everyone, will it change your process or merely refine your understanding of risk? That distinction defines maturity. Share your thoughts, and if you want to keep learning how experienced investors use information without becoming captive to it, stay connected. Subscribe, follow, and return. Because the real edge is not having more data, but knowing how little any single number deserves to be trusted.